it's going to continue that way, you actually had call skew blowing out. So I would rather watch something that is connected to actual dollars and cents than just sentiment itself. Now, with that being said, here's the reason why. If you look at all of these changes in the interim, you basically have sentiment positive, negative, and it doesn't really have a correlation with price. I mean, if you actually look, all of these sentiments right here, the net sentiment has been positive this entire time. I mean, there's little moves down, but overall it's positive. If you were, and you even have the negative periods of time as well. If you try to use that as a metric, it's going to be really tough to fade over the long term, right? You would want to stack it. That's why I think some people who use sentiment, which I think is totally fine, if you're using that kind of as an overlay on top of all of the other kind of pages in the book, the analysis that you're already doing. And so that's the one thing I would just kind of say about sentiment. I don't want to get too caught off on that. But when we are, kind of going through a couple of these questions, because we're going to have the statement by Powell in a little bit. And let me see. Just want to make sure I have it up for everyone. And let's go through it. There's a couple more questions about how does this kind of connect to Kevin Warsh. And let me add James, what's up, man?
Well, I heard you talking about MSTR, so I figured I'd have to come up here and, make sure you're not throwing them under the bus too much.
No, I actually think that MSTR is probably going to do decent here. But I think that it's just more about how exactly do you kind of go through the difference between kind of a fundamental idea that has some real edge versus just kind of this continuous fading of an echo chamber, or like trying to find confirmation bias on your timeline for whatever kind of idea that you have, right? I actually think you're better at that than I am overall. But I think that, it's kind of this entire setup with crude and equities and kind of everything else as we're heading into FOMC, the actual meeting. And I was laying out for everyone how Fed basically thinks that inflation will rise a little bit, growth will be fine. They still want to do one cut this year and one in 2027. And now the entire question is, how are they going to navigate that and kind of focus on what are the tensions between the two? And I actually think Kevin Warsh is a really interesting thing here because, yes, you just had one dissent with Stephen Myron, where he said, I think we should have cut this meeting. Everyone else thinks they should have had paused. So you basically have the majority of everyone saying they should have paused, which they did. But now the entire kind of wild card that's in there is Kevin Warsh and how he's going to begin to impact things. And I don't think it's just about, Kevin Warsh only has one vote, so he doesn't matter. Well, sure, maybe, but he's also going to be the chair. And on top of that, I think that they're going to figure out some ways to politically play the entire situation and put pressure on people or not put pressure on people or rally people together instead of play the political process. Because I think at every step of the way, everyone has kind of been surprised by Trump because they're like, he's supposed to do the political thing, right? Like, you're not supposed to play this game like this. That's not how the game is played. And he's like, yeah, I don't really care. And I think, Scott Besson has been a great example of that, right? Where, he is not really played by any of the rules that any Treasury Secretary has. So I think that is going to be the wild card as we move into this year.
I think just to add on to your point, I think we are addicted to, what do you call it? Is it the Dunning-Kruger effect? When you think like you're good at one thing, you're good at everything. Yeah. Is that what that is? Like we all are like the same INTJs or whatever, right? Everybody knows about this whole thing about traders and risk allocators. We're all like generally this similar personality type, and how I feel like we all just get addicted to assuming we know what's best for everything and that our sources are the best and our networks know the best and blah, blah, blah. And this is like it just gets more and more and more that way. And like the epitome of this, I was telling you the other day, was this predictive history guy, right?
Totally.
And how he put out a video yesterday talking about game theory and Epstein and stuff. And then he called Jared Kushner the new Epstein.
Right.
And I was just like, this is so out of left field wild to me. And it happened right after he got this swath of a new following because of his Iran war piece. That
Right.
was also so hyperbolic. Every 2 minutes, 3 minutes saying, guys, this is the end of the world. Don't you see? It's the end of the world. And I just can't help but think like it, like sentiment to me is mattering more and more. And I know a lot of people try to move away from that, but like the crowds are getting, to me, just they're getting smarter, but at the same time getting dumber. And
Yeah.
I just like the tale of two tales is just like everybody living in this binary world. And it's just unbelievable to me. I have rolled my eyes more in the last couple of weeks than in a long time.
Yeah. This is
That's
yeah,
my
I think
rant.
I think I know some of these comments are great. I think that on the topic of like sentiment and that idea, I think it's about the fact that like you're getting so much more like psyoped today, right? So it's not about like, oh, like what's this person saying? Let me do the opposite, right? Because that doesn't work unless you actually know that it's an indication that you should just do the opposite, right? Like I remember, I think this is kind of more my view, and I know I'm kind of like mimicking him a little bit, but like I think Peter Thiel had this great section once where he was talking about, he's like, yeah, I think this is like a pendulum swing of like going back and forth of all this stuff is just like two different types of people just being wrong in just different ways,
Yes.
you know? And
Yes.
like, here's the thing, love, I mean, I know he's a very polarizing figure, just like Alex Karp. So many people love him and hate him. The thing is though, I feel like that every single time he comes out and talks about something, it's always nothing I've ever thought about. Or it's always kind of like out of left field. And I'm like, wow, I'd never kind of had that take before, right? So I think that's kind of one of the things that is going to pay a premium in this kind of like period of time, right?
Yeah.
So I think that's real. Will be very interesting to see like what takes place with that moving forward. I'm trying to pull up, see if I can pull up this.
While you're doing that, all I'm saying, guys, is like whenever you are reading something these days, or you're seeing a lot of these articles and posts go mega viral, just take a second, sit
Totally.
back and breathe for a minute. Like I think Citrini was another one of the better examples of this, right? Where he literally starts off the article by saying, guys, this is just a thought experiment. This is just if you will, a tail risk, a scenario that we're going to play out and reverse engineer. Does not mean it's going to happen. And then I could just see everybody saying like, yeah, get that paragraph out of here. We want the doom, you know? And I think it just like, we all want the doom because so many people just feel it's like goes back to the financial nihilism thing, right?
Totally.
And people just feel like so disenfranchised or like fought against or just not given the opportunities that they want to just see the world burn. But the funny thing is, to me, I'm like, if the world burns, not enough of you are going to know how to pick up the pieces and put yourself in a good scenario, because you won't even have anything left. You won't have anything to pick up the pieces. So I'm just saying, be careful because you never know.
Totally.
You never know.
I'm gonna try to share my screen really fast. Let me know if the audio is coming through. I think you need to mute yourself when I have it up, just so that you don't come through too. But let me know if you can hear the audio on this.
Of those dots and how the forecasts show up. You could have had one very strong forecast.
Can you still hear? You can still hear me over it.
Number within the group. Cool. There are people who believe.
And by the way, for YouTube rights or whatever, you might want to talk every once in a while to make sure they don't flag you for like a if you play something too if you play something too long, I think it's actually like not allowed.
Got it. Good to know.
Yeah.
Yeah. You know what's so funny is I always I will have these Bloomberg people. It's the only time of the month or quarter or whatever it is that I ever like pull up the Bloomberg TV. And it's just like shocking to me that these people sit around all day talking about nothing. I could imagine just being in that room and just being like, yeah, you know, like, and just going back and forth and these guys just doing their thing. It's just wild to me, you know?
They're yappers, man. It's a skill set. It's a skill set, right, guys? Yapping.
Let's see if I can do the official Fed stream.
Hey, by the way, you guys out there in the comments, if you think we end right now, we're down a little bit in like S&P 500 today. Let me know if you think we end the day up green or if we stay red. Toss it in the comments. I want to see what you guys think out there. How many of you are doomers and how many of you are boomers? Don't forget, boomers always win.
Let's see. What have been some of your kind of other thoughts for where we're heading over the next, I mean, you know, into this summer period of time? Like how do you think about trading and managing risk and thinking about some of these moves as we are in an environment where, you know, VIX is sitting at 23, you know, you have these ranges that kind of blow out here and there, but not enough to put on a ton of size and just buy with the leverage and conviction and size. But how do you think about these kind of types of periods of time?
I think I can understand that it's difficult for a lot of people. I, for one, think like if I bucket, first of all, I think everybody needs to understand and grasp the idea of volatility, right? Like the expansion or contraction of volatility, right? And how that affects their personal trading. Because you could be a chartist, right? But you could do the same charting in a high VIX environment and a low VIX environment and get completely different results. And if you have no idea why that's happening, like, what are you doing, right? Come on. So I bucket the VIX into like sub 20 VIX, 20 to 30 VIX, and then 30 plus.
Right.
So historically speaking, for me, my worst results, and I have 10 years of data on this for me, have been within 20 to 30 in that second bucket. Because you have, not only do you have volatility, but you have a lot of false breakouts, sentiment-driven stuff, news catalyst-driven stuff, squawks, you know, Trump this, you know, I've gone through 2 Trump presidencies now, and the ability to trade that can be difficult if you're not kind of set up well for that mentally. Like if you're a range trader and you're good at kind of like fading sentiment and finding extremes and cross asset ability to kind of move, pick and pop, like this could be actually a really great environment for you. For me personally, it's not. I want to do a lot of stuff, but for me, I'm like, okay, James, like relax. Like if you want to play small right now, right? And then let the game come to you. We'll probably feel and kind of know when we're exiting that kind of range, whether we're going to climb at the wall of worry, unwind a lot of hedges, get to the end of the month and press forward, or if we're going to kind of unwind everything, roll over, break lower, and head down. I'm confident in both of those other ways, but right now, whatever. And I'll let you jump on.
Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its
Yeah, I'm
highs
actually
in
pretty sure
mid-2022,
that's the first time they've
but
ever
remains
showed
somewhat
those
elevated
projections in a
relative
meeting.
to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy.
So I didn't get the second part of your question.
The consumer is going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more of the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Timoros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices are the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. And we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can, we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So We look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration, because that's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, it has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much. And I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal. But there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and the downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal. And we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s. And that's, I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course, people will feel that. But I don't want to speculate about what that might mean, because honestly, that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting. And usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting. And, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value perhaps in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction. And so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, you know, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up the cost of food and other goods that really rely on it to.
So
move
I think
across the
it's a
country.
more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, expect it to continue. And we haven't really started to see the effects of generative AI. And that should certainly contribute to that. So it's quite unusual. And it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story. And if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Thank goodness.
Another performance by our great. I mean, he might as well be a forefather of our country. That guy.
I mean, put him on a bill. Put him on a bill.
Put them on a bill. You put whatever money they print, like put him on the SLR, whatever that is.
You know, it'd be funny if they only printed money based on whoever the current Federal Reserve chair and president is, or something like that, and then you can be like, oh, we have so many Powells in the system after all these years.
That would be hilarious. Yeah. 40% of all the money ever created are Powell bucks.
Yeah. And they would just be around forever. I think it's, I get the ideas on either side about him. I think he's had to walk this line on both sides. I think that the toughest part about I think what he's trying to play right now, and he's kind of done, right? Like he did his entire play. Like he responded to COVID. Maybe he screwed up on inflation by letting it go to 6% without hiking rates. But let's not talk about that. And then, in charge of one of the largest hiking cycles in U.S. history because they fell behind. But let's not worry about that. Now, he's just threading the needle. He's trying to be like a boring boomer who just puts their money in CDs. And they're like, well, let's just play it safe for the next couple of months until I'm out of here. I think that's the vibe.
Well, he has keys to the Citadel and you don't. So might as well ride it out.
Totally.
Be safe here.
I think the entire takeaway that I have is that overall, Powell and the Fed's entire stance to everything is they're just going to try to pause and not take action toward inflation or anything like that. Because even if they're like, oh, we need to get more hawkish or something like that, all they're going to do is say, oh, maybe we're not cutting this year. They're already, kind of expecting they're saying, oh, we're going to probably cut this year, right? And, the fact that I think what the entire market is looking for right now is about certainty for duration. The moment that, and this is kind of why I'm going to wait a little bit more because, we'll see how we play out tomorrow and overnight. But if we can't have more certainty about the duration of kind of this entire inflation situation as it relates to kind of what they're talking about, I think there's going to be a moment in time where everyone now we have crude here. It's actually funny because now gold and silver are wicking down and we haven't had any news yet. So I'm still waiting on those. But, when I just think that the higher VIX environment and this duration, there's just going to be some moment where we're going to get clarity about the derivative of a duration of the war is coming to a close. There's more deterioration in the labor market that's going to cause deflation or disinflation or something like that. There's going to be some point in time where right now the market can't really see how much the Fed is not going to take an aggressive action that's going to cause something, right? I think that's one of the things that I always look at is the Fed intentionally taking aggressive action, or are they being more of a passive participant? Because sometimes they come into the market and they push it around a little bit, right? They're like, hey, we think this, we're doing this. But right now, they're a very passive participant relative to this duration question. And I think both of those, the fact that we don't have certainty about either of those, is one of the reasons why you have these wider ranges. And so, I think that it'll be interesting. I think if we can't, have some mean reversion into the close today, and into Friday, then, it might end up being a period of time where we're just going to chop in a range for a while. And I think this is one of the things that, I'll share this. This is one of the things that I shared last night with everyone. And I think this is, if you guys haven't got the regime model, that I sent out last night, you go to the position unwind is bullish for equities. We talked about all this on the live streams last couple of days, but here's the regime that we're in, where you have a little bit of, again, I think Powell did a good job at defining the difference between stagflation and then just inflation rising, right? And, we have a very small impulse of stagflation where growth is still positive, but inflation is moving up faster than growth. And you can go to this dashboard maps that with credit spreads and inflation swaps. You can download that here and go through that on your own. But I think as long as we have, it's just going to be so tough. We can grind in a direction in the S&P, but with the amount of premiums that we have here, I just think it's going to be really tough. I don't have a massive, and this kind of like lays that out. This is why at the end here, I just said, hey, my view on the global economy is that recession or stagflation is not an imminent risk. I think we're going to have little shocks here and there, but we are not seeing a massive injection of credit liquidity in the cycle that would smooth over all the skeletons under the floorboards. The implication is that you really need to choose your spots. And this kind of goes to what we talked about at the beginning, where kind of know your spots. And at least in global assets, I mean, that's why I like the Oracle and Hyperliquid and the PER bet that I've been laying out. And I'm not as sized up and aggressive in some of these macro, assets until we get that clear duration, the clear indication about how long all this is going on for. Because when that happens, there'll just be, I believe just a massive vol crush across a lot of different things. And who knows if that happens once you have, Kevin Warsh on the scene or someone else or something like that. But I think like the fact that, we're in this range with the VIX is, creating a lot of challenges for people to bet on momentum, right? On the upside or downside, because we have so much hedging pressure that's there, but then we haven't had that indication from Trump or whoever else it might be that, okay, like this is slowing down. So I think those will be the things that I'm watching closest. And then, PER and Hyperliquid have just been kind of the things that have remained resilient through the entire thing, which has been really nice. I think that has been the fact that they've had uncorrelated returns to the S&P and Bitcoin and things like that have been really interesting. And then the Oracle trade, we haven't really moved at all. I mean, we've ticked around a little bit, but nothing has really happened. I think it's been overall just neutral to the response of things. But I think once equities really bid, Oracle is going to be one of the highest beta names in the next section of the cycle. And if you guys are kind of new, we did a whole live stream and video on that you can go find on the Substack. So those are kind of the views that I have as we're moving into that. How would you kind of think about, when you think about the environment that we're in and sizing and taking multiple decisions and saying, okay, how many times can I be wrong in this situation and things like that? How do you kind of think about that?
Yeah, well, it does seem like what you're saying is true, where we're in this like weird waiting game where there needs to be some sort of decisiveness, where it's either catalyst driven or market driven or whatever. It almost feels like the hedges plus people buying the dip or whatever you want to call it is like they're almost pinning it in a weird like ping-ponging range, if you will. So for me, I don't really know. I just like we spend a lot of time just talking and spitballing, right? So that we have a lot of different ideas kind of clanking around in our heads, and what are the possibilities of what could happen to each of those assets, how we would play them, upsides, downsides. And then I feel like what I like to do is just kind of wait around until the signal gets so strong in my head that I'm like, I need to do something now. Right. But I don't personally feel like I have any of that noise in my head at the moment. I mean, I'm a little bit like bearish precious metals and oil, but like it's not a screaming opportunity either. So I'm like, yeah, maybe I'll putz around in there for fun with like 0.25% of my bankroll or something, right? But like, I'm not taking any like 2, 3, 4% bets anywhere at the moment.
Right.
And if somebody thinks they have that in their chamber right now, they better have like a true edge. You know what I mean?
Right.
Or else you're just like, you're lying to yourself, in my opinion. So that's my thoughts. I'm just kind of like, I was thinking about it today. I was like, I really haven't done anything today. And in a weird way, I'm like, good. I'm like, good. Like, don't do anything today.
Totally.
Nothing's clear. We're going into FOMC. Like, let it shake out. Right. There's a couple people in my Discord that I run who have been trading today and have lost some money here and there. And did they have to trade? Maybe their signals set up. Maybe they didn't have to trade at all. I don't know. So it's just interesting to think about.
Yeah, I agree. I think that go for it.
Sorry, one more thing. I just want to say, like, I'm pretty impressed with like I'm a hyperliquid bull, have been a long time, whatever, I get it. But the thesis you kind of originally had with like PER and hype and all that, we had not seen. I mean, hype has been resilient in certain times and acted as a little bit of a risk off thing, but generally speaking, when crypto would go down, hype would go down. You know what I mean?
Right.
And to kind of be bold enough to say, I actually think hype can outperform not only Bitcoin, but like equities. Like
Right.
when like equities are down and Bitcoin's down, hype could go up and stuff. That kind of seemed ridiculous.
Totally.
And the fact that we're seeing that is like pretty wild. So I wanted to give you some props there, because that just seemed like I kind of saw what you meant, but at the same time I was like, I don't know if it'll actually do that, you know?
Sure.
But,
yeah. I mean,
but it has, you know,
Totally.
It's kind of crazy.
I know it has been wild that, like, I feel like, I mean, I always look to the market for my signals. I don't pretend like I'm like, oh, I know what it should be doing right now. It shouldn't be doing this. You know, I think that there's always a scenario where you say like, hey, let me like de-risk a little bit because things are getting dicey, and then I'll just put my risk back on later. Right. And I think that it's been obviously nice, but like, I think the entire thesis that Hyperliquid could deviate from Bitcoin, and then you could also have it function in this like different uncorrelated way is, I think in itself, I think the potential for that when I was, before all this happened, the potential for that is why I was like, okay, well, this could be interesting, because like if equities sell off a little bit, could it get whacked? Yes. But then, I kind of like keep that in the back of my mind and say, okay, maybe I'll take off a little risk here or there. And then the fact that every day we go through and I'm like, okay, hype is up and Bitcoin's down. Interesting. All right, I'll take note of that. And then S&P is down and then hype is outperforming still. And I'm like, oh, interesting. Okay. And then I even see PER outperforming. It's not even deviating from hype really. And I'm like, oh, interesting. That's another signal too. If I see that shift, then maybe I'll change my mind. But the nice, and then here's kind of the thing that we've talked about so much is, talking about and getting long PER down here in the low threes, right? And now being double that basically now gives me so much room to take a little bit of vol if something happens, right? And now, you have that cushion. And I think that's something that, when people are trying to manage risk and things like that, what they don't think about, because I think a lot of people are always trying to think like, well, let me wait for whatever it might be, so until I can kind of like start getting a trend and a pattern and stuff like that. But like the hardest time to buy stuff is like, honestly, the hardest time for me when I was just like putting up a ton of exposure to buy, I remember this. It was right here, like literally at these lows, because I'm just like, oh man, we just like puked here, dumped, and then like the next day we just ripped. But I was just like, I know that this is like the most amazing buying opportunity. And I remember buying there and putting up a lot more exposure there. But it doesn't, I think especially with the context, it doesn't look amazing, right? I remember Druckenmiller one time saying, he's like, oh, if you don't kind of feel a knot in your stomach when you're going to put up risk, you're probably not a good trade, So we'll see what happens. I'm still cautiously optimistic and open-minded. And I think that the next, again, it's just like the last year in 2025, like this whole period of time was probably the period of time I was most aggressively long, right? Like this entire period, and then even up to here, like in this period, I was so aggressively long and had so much exposure in ES long. And It's because real rates were falling, credit was getting injected to the system. I did a lot of content on the credit cycle. And now some of those things have shifted. I don't want to short the S&P. I don't love that. I don't love betting on stagflation right here. I don't love shorting bonds. I don't love getting long crude. I don't love any of those trades. So my entire goal right now is how do I pick my spots and find some other things? And so I'm working on the next trade right now. Like, what's the next bet? I have some ideas. I'm not going to share them yet. I'll be sharing them on the Substack when they come. And then also I have all the new AI kind of agentic models out that I'm working on right now that I'm almost done with. So like, I feel like there's so many cool things happening right now, even though markets are kind of in this like weird limbo spot, you know?
Yeah, I agree. Just before I forget, it's important if anybody out there is actually in the per trade, you really have to think about it like Global Flows is thinking. You're thinking about it from your personal situation, right? Buying at lows, not in your stomach. Now you have room to kind of let the trade breathe. You can handle the vol maybe better than a lot of people. You have now space in your head to think clearly, right? Whereas a lot of other people need like sit back and think, where did I actually get in on this trade? And how is that different from where he's in the trade? And what is my risk tolerance for this trade? And what does my time horizon look like here? And how well informed am I about the hyperliquid ecosystem, the things changing on the Regulation and Clarity Act side of things, the HIP-3 integration, the HIP-4 integration? Like, there's a very wide range of how involved or not involved you are in this trade. Right. And because of that, when you come on to say like, oh, this went well, or oh, this didn't go well, just, you got to remember the differences along the way of how everybody, like, I executed this trade slightly different than you, right? I have different expectations than you. I have like whatever. So just remember, it is ultimately on you, right? Global Flows could only do so much. He could only put out so much stuff. He could only do this, but ultimately, like, you're clicking the button. So make sure you take the responsibility for the results here.
Yeah, extreme. I think the thing that I keep thinking about from all the podcasts I'm listening to are guys that are talking about AI at all the top firms. The one piece of advice they're like, oh, I would give this piece of advice to my kids is extreme agency. And you can just like the amount of people I meet today with extreme agency is just so low. It's just so low. And I think that's just like one of the things that people just don't completely get yet, because it's just about taking total responsibility and total ownership and not letting the kind of all the noise or insecurity or fear that you have to slow you down from taking action. And I just think extreme agency, extreme accountability, extreme ownership about every single thing that you're doing, and understanding that the only way that you can accomplish the goals that you have is if you do it, instead of in the back of your mind harboring a lie that says, well, if I just do this one thing once, or if I just have someone give me a handout one time, or if I just get lucky this one time, I don't have to go through all that difficulty, right? Like, that is, I just think the lie that's working against people more than the entire ability to just be one of the most high agent people in the world.
But that's all I need. It's just one chance, man. Just give me the one chance. I'll figure it out.
Yeah, I think the best thing is even though now I think about, even if I have the best trade and best setup on planet Earth, I still know that I need to be humble enough to recognize that I could still screw up the best opportunity ever. Right? Because all of us have had a thing where you're like, oh, this is the most amazing opportunity. You get in, you get shaken out, and then it just rips, and you could have made so much money, and you're not on size, you're not in, and then you're just kind of sidelined. And, you know, you are the differentiator in every situation you approach, as opposed to thinking like, I just need my circumstances to work out perfectly for me. It's just a very I think, prideful, ego, self-centered view of the world that you have this belief that the world needs to shape around you to become successful, or you just need it to happen once or something like that. Instead of thinking about how can I build myself into a robust person that actually is able to be, an input into other people's lives and into your own destiny and your own future. And you're able to build something as opposed to just hope that the waves of the storm carry you to an island that's like a perfect place or something like that,
I agree. And the tools we have to have more agency they're out there.
Yeah.
Just got to find the people to surround yourself with that you could get some of that osmosis from, Sometimes,
Absolutely.
I just think, I was thinking the other day, one of my big issues is flip-flopping with my nutrition, right? I'll be dialed for 4 months and then I'll fuck off for 4 months and then I'll dial it in for 4 months, and a lot of it just comes down to friction and the things surrounding me. It's just like the atomic habits bullshit, where it's like the things, how you set up your life is going to either add or decrease friction to the things you're trying to do. And the people around you in the trading world, oh my gosh, do they have a huge impact on your results. And you need to have people around you that have a lot of agency and are abundant thinkers and presume success in a humble fashion, And if you could get that, you're set up well. Most people just have a bullshit trading group where it's like a little cope fest. It's a little bit of somebody's winning, 9 people are losing, and it kind of rinse and repeat.
Yeah. Yeah, I totally agree. All right. Well, everyone, thank you very much for joining the live stream today. You can find all of the research I'm doing at capitalflowsresearch.com, where all that is. And then all of the videos that James is doing is on his YouTube channel. You can go to find all of his stuff. Got his Twitter account, his handle at James Rosenthal. And then James has a Discord with all of the kind of different community that he's running, which is really cool. So if you're looking for a community to be a part of that's intentional and mindful, and people who are trying to build each other up in a positive way, that's a great place. I would encourage everyone to go there. So it's, the Substack chat is kind of challenging for that a little bit sometimes. I think it's nice to have a cool place as a Discord or something like that to be able to connect with people. So
we could build you up or break you down.
One of the two. If we're breaking you down, it's probably constructive. Sometimes you have to be broken down to be built back up, right? Is that how it works?
That's what they say.
All right, everyone, thank you so much for joining. We will see you guys next time. Peace.